Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about what the forward-looking indicators tell us about spring housing demand. We're also going to talk about inflation, jobs, tariffs, and Canada becoming our 51st state. First, I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. Wow, what a crazy day, week, everything. Every day there's always some headline drama, and it just makes life more interesting.
So, there's some headline drama, and that makes the economics really crazy to try to track. So glad you're doing it. Let's talk about spring housing demand.
Yes. So it's almost spring, and we always say by the end of February, early March, we get somewhat of an idea of how the year will go. And crazy enough, the weekly purchase application data is positive year to date, even with rates above my growth target level. And I track purchase application data a little bit differently than other people. We've had to make some major adjustments to everything after COVID. So I look at the weekly data, but in context to how low demand is, we keep perspective. 4 positive prints, 3 negative prints, 2 flat prints.
Since the beginning of the year?
This is from when mortgage rates peaked. I usually take the second week of January, from 7.25 down to 6.64. Last year, mortgage rates kind of, the bottom was just toward the end of December, early January, and then they shot up to 7.5. So for a good period of time, about 18 weeks, purchase application data was negative 14 times. We only had 2 positive prints, 2 flat prints last year. So even though the volume curve wasn't crashing, the weeklies were not positive at all. Different case this year. We actually already have double the positive data going into spring than we did last year. So I wouldn't consider this like a big growth data line now, because to me, you need about 12 to 14 weeks of positive purchase application data to get something going. Last year, we had that when mortgage rates started to fall, demand picked up. Everyone kind of ignored the housing data because they saw the low levels of purchase application, but it was good enough for a couple 100,000. We had 12 positive prints, 5 negative, and 1 flat print. So in that context, not bad, considering everything that's going on, but just imagine if rates just go down to 6% and just stay there. That's it. We're growing sales, not a problem. And of course, we have more inventory this year than the bottom of 2022. So there's a lot of things that are in place now that are much different than the previous years. The Fed's already in a rate cut cycle. The spreads are getting better. There's more active inventory. Price growth is cooling down. These are all beneficial for demand going out in the future. And this is why when we do the Nerd Tour, kind of the worst is over. We just need that one last push to get there, and then you could grow sales. And then we'll take it from there at that point when we get a higher level of sales to work with and what needs to happen. But that we got to get that first inflection point off. And I've always said you need rates down towards 6 with duration to get that to work.
So let's talk about the larger noise that's going on that consumers, they hear and they might be affected by, either whether that's like, their job. No, don't let me ask it. Their job might be gone, or they might be afraid their job's going to be gone, or they're like, oh my gosh, we're seeing higher prices on this, and all the talk of tariffs or taking over Canada. What effect does that have on the consumer, and when will you see that, if ever?
If it had a big effect on consumers for buying homes, purchase application data would be negative.
Okay.
Like it was last year.
So
last year we did not. Yeah, last year we didn't have the trade war tap dance. But for now, it's kind of like in COVID. Remember in COVID, like when we did the COVID-19 recovery model, you could understand why people were laughing at me, because I was like, oh, housing demand will be back like in 6 to 8 weeks. It was, you're crazy, man. There's 20 to 30 million people unemployed, and there's a global pandemic, and who's going to buy a house? I said, just give it 6 to 8 weeks. Fastest, sharpest recovery in the history of America, right there. Why? Because 133 million people were still working and mortgage rates were at 3%. So if you wanted to ever use a period in time where, oh my, you could totally understand if people wanted to just,
That's true.
No, they didn't. As soon as they thought, okay, we're living, let's go, they bought homes. So um, for the housing side, we haven't seen that just yet. There's always going to be consumers that are, oh, should I ever buy a house now with prices here and everything? But in general, macro terms, we haven't really seen that impact yet for housing. You could say the consumer spenders have changed. Of course, a lot of people were buying stuff before the tariffs and confidence is down, and I totally get that. But if I was to make a housing claim, then the data would be more negative than they was last year, because last year we didn't have the trade war tap dance or federal workers being fired. Here, rates are better. So what? The rate variable, I always say, the housing market revolves around the 10-year yield. All this other stuff, noise to a degree, but the 10-year yield, whenever it falls, demand picks up. And we just keep it as simple as that until something changes to where it can materially change the housing ecosystem. And again, when rates go up, demand gets hit. Last year, rates went up. There was no trade war tap dance. There was none of that. Housing demand, the positive curve went away. So millions and millions of people buy homes every year. We had near 5 million total home sales in 2023, near 5 million total home sales in 2024. Where we're going right now, even if rates don't go lower, we're going to have near 5 million total home sales. The peak in the last decade was near 6 million. So a little bit, perspective on that side. But if I was to say that we would see a negative curve because of the headlines, purchase application data would be negative pretty much almost every week, like it was last year when rates were rising.
So we'll be able to tell. That is wild when I think about it. It has been, I think this week marks 5 years since the pandemic was officially closed everything down. And then you wrote your recovery model on April 7th.
April 7th, 2020, the 10-year yield
Yeah.
was above 62 basis points. The St. Louis Credit Financial Stress Index had already been falling. Game was on. Wayne's World. Game on. We were about to run. We were about to run right here. That was literally, as a data analyst, that was the best year ever. Because while everybody was doing their depression mode and everything, we're gone, homie. See ya. Bye, losers. Goodbye. See ya. We're running 4-1 in the 40. You're still running at 8-5. Don't catch up. You're never going to catch up to us. So different marketplace now. The 10-year yield has gone into it's marginally helped demand, but it's a little bit better than last year's data. I would tell you this: our pending contracts are still slightly negative year over year, so we don't see any. I don't see the shift change. Again, if I had 12 to 14 weeks of positive data, then I could go with this. But I would just say that it's better than last year. And purchase application data takes 30 to 90 days to hit the sales data. But again, we're working from such low levels that it doesn't take much to move the needle. So that has to always be the big perspective of this, that if we were really rolling with housing data, it'd be like what it was in 2020, right? We just get this sharp V-shaped recovery in purchase application data. It's up 33%, 35. You have such a low bar to work with that the velocity should be there. We just don't see that in the data. Rates are too high. If rates go lower, advantage, disadvantage, the housing market has an advantage because the cost of debt and the sales levels are low. If existing home sales are at 5 million, that's a different story. But you can see the difference between the builders now and the existing home sales market.
Yes.
The builders are working from 2019 levels. That's like 5 million existing home sales, like a million higher. So they have a higher bar to work with.
Well, let's talk about the builders because we're starting to see, obviously, we've seen in your trade war tap dance parlance, I mean, we've seen some crazy things happen in the last couple of weeks. And so what you've mentioned is that they still have homes that are under contract, a backlog they're working through. We read a report this morning, I think it was Wall Street Journal, that talked about, builders after the election started, laying in extra, the ones that could, laying in extra materials in thinking about this potential trade war. So 2025 supply is probably fine, but 2026 is where you might start seeing it. What do you think?
I would actually disagree with that in this sense. The 2020 supply for the builders is not good, right? The builders, on the
2020?
other hand,
You said 2020.
2025 for the
Okay.
builders is not good because why? The builders are here to make money, and their total units of completions. We talked about this on Yahoo Finance. has been rising to levels that they don't issue permits because they just don't know. And this is all before the tariff situation happened. So now you add another variable into them, and their stocks have been performing bad, but they tend to do better again when, oh my God, the 10-year yield goes down, mortgage rates get down to 6%, because not only do they have that 6% curve, they could push rates to 4.5 to 5.5 to sell product. The big builders have that advantage still to a degree. The smaller builders, not so much. So I would argue that the completed units for the builders makes it more problematic. They don't really have the pricing power, like especially in the South, to do that. So don't look for permits to go anywhere. And my concern is that we start to see it impact the residential labor force, right? And again,
Right.
that's my recession trigger that I'm looking at. And if that happens, then oddly enough, in some ways that can help rates go lower. But the builders were complicated going into 2025, and that hasn't changed. It's just gotten worse with the possible tariffs out there coming up, and that's why they wrote to the president that first night, that first Friday. They were like, they had that sheet ready to go,
They did.
and
The National Association of Home Builders is what you're talking
yeah.
about when the first tariffs were announced. Okay, so what does that mean for the housing market in spring? What does that mean for the existing home sales? Because will you have less options in new home builds?
Well, here's the thing. Existing home sales market is just a much bigger marketplace, inventory-wise, buyer-wise. So the purchase apps and the pending contracts, I mean, right, our pending contracts are still slightly negative. So purchase apps take 30 to 90 days. We'll see if that just brings the curve up a little bit. But I've always stressed this. If you really want something, you got to take rates lower to about 6%, and you just got to just stay there. The builders have shown you can grow sales back to 2019 levels. And that's a kind of a sub 6% mortgage market. The existing home sales market is different. And this is a good topic. Somebody had asked me, like, why didn't the Fed raise rates in 2021? I said, well, they don't really revolve their mandate around the existing home sales market. And there was a lot of people who didn't believe in the recovery. It's a little bit different for us because we retired the COVID-19 recovery model on December 9th. So we were just like, okay, that's done. We're in another stage. But because the unemployment rate was still high and COVID, nobody knew exactly how many people could go back to work. They kept rates, and we wrote that in February of 2021. We need higher rates. This is not a good thing, what's happening right now. But also on the other side, people say, well, why isn't the Fed cutting rates to get mortgage rates lower? They don't revolve around their mandate around the existing home sales market. So in their eyes, if you're trying to balance the economy, right? Do you really want people having sex and buying homes and buying stuff, right? This is the only thing they can really control on that side. So we still stick with the Neil Kashkari. We can't balance the economy with 6% mortgage. I still can't believe you said that. But in any case, there is your mindset right there, right? If they're saying that in 2023, you think it's not coincidence that when the 10-year yield gets around to the Hodor level or the Gandalf level, Fed people come out and go, hey, guys, market, you're a bit ahead of yourself, right? They have the ability to just even ignore that move lower. They don't, right? So existing home sales just isn't in that dual mandate preview right now. The new home sales market, if you start laying off workers, that makes sense, but not for the existing home sales market.
Okay, at what point does the trade war tap dance just become a trade war?
We'll know on April 2nd,
yeah.
2025. I'm glad that they removed it from April 1st. Okay, that was like going to be a joke. Like, I'm like, come on, you're trying to be funny now. We're going to do reciprocal tariffs on April. So, of course, for us, wax on, tariff on, wax off, tariff off. So back and forth. I think this morning we did 200% tariffs on Europe. For
on champagne, right?
On champagne and wine and stuff. And again, we kind of brought this up a few weeks ago. He's going to have to pull the trigger on some things because if people start calling his bluff all the time, that's not going to work. And of course, the stock market's down again this morning. It's Thursday morning. Bond yields bond yields were elevated to a degree. We could talk about inflation next, but then when the markets are selling off, money goes into the bond market. So we're kind of back to that old relationship where when stocks fall, the 10-year yield can go down. But we'll know a lot. I think by tax day we'll have some clarity. But this can't go on for 4 years. This back
No.
and forth stuff. This you got to make a decision. All right, if you go full tariff, go full tariff, or if you're going to make a deal, make a deal. But we can't. We tried this in 2018 and 19. It didn't work really because business investment stopped. So at some point you got to pull the trigger out there. And of course, the stock market put up a fit back then, and the stock market's putting up a fit right now. So this is why we call it a trade war tap dance. Think of Daffy Duck dancing. Like that's what I think of back in the days. That's the GIF I used to use back then. And we'll see what the final result is. I don't watch TV, but I saw a clip of like Peter Navarro from UCI or UC Irvine, by the way. In any case, he talked about.
Is that your alma mater?
No, that's the college near me. But in any case, he was like, Canada, calm down, like lower your tone. I was like, well, it's us. It's us. Like we have so much leverage over Canada and Mexico. I don't think people understand that so much of their economy is that this is why we're trying to do this. But I'm assuming that this is to get some kind of deal. But if it is, let's say I'm wrong, and we go full blown guns of never own tariff. Right? We're going to do what I always say. If you really believe in tariffs, you put them in day one, no negotiation, let the war start. That's a whole different ballgame because you're going to get a big trade war, and the economy does get hit on that side, and it's going to take time to like work tariffs into the economy and try to get production. You have to get something out of it, right? So we'll see. We'll see if this is just part of the trade war tap dance, but I still think he has to pull the trigger. He can't keep on taking it off. The stocks go down. I mean, a lot of people say that this is different than his first presidency, but he didn't do the trade war tap dance until 2018. So it's a much different marketplace. And we'll see by April, we'll have a better idea.
Okay, we're going to talk about inflation, but first, since you're talking about our neighbors to the north, let's talk about Canada a little bit because so much news right now, and the party line is that Trump, I mean, from his office, from his press office, which is changes a lot, but he's trying to crash their economy so they can become the 51st state. Of course, everyone thought this was a joke. Like literally everyone thought it was like, oh, okay, well, it's just Trump being Trump. It looks less and less like that. What do you make when you hear that?
If I'm to believe that, okay, he would have put the tariffs in day one. Like this is why if I was this is the same point I'm going to make to everyone. If I was a tariff person, I'm putting tariffs on day one. I'm not negotiating. So if I really wanted to crash the Canadian economy, I just simply put tariffs on and go, oh, by the way, there's no negotiation. Go ahead, bring the tariff war on. That's if Trump really wanted to destroy Canada and force them to join the become the 54th state, he would simply put the tariff on and that's it. Because over time, I mean, this might take years and years for Canada to do. I mean, I don't think that's going to happen. But if I was to believe that, you have already done it. But we're doing this back and forth. I mean, how many times every time I see on X, oh, we're going to do this with Canada. We're not going to do this. We're going to meet here. I just don't believe it. Because if I was a tariff person, I'm putting tariffs on day one. End of story. Because it's going to take many years. We're talking many, many years for that to kind of work itself back into the economy. One terrible take, though, I do see is that we're firing government workers to go do manufacturing jobs or something. That's not a lot of people. We're like firing 325,000, 162 million people. We're not going to change the whole economy for 350,000 government workers, right? To do manufacturing work. So that's not a good explanation. What you want, what Trump talks about, is not relying on other countries for stuff and just building it here, which I don't think we can do it in an efficient way anytime soon. So this is why it's a trade war tap dance to gain something. But if he really wanted to crush Canada or Mexico, he could by just putting the tariff in and go, we're not taking your calls because we're not negotiating. But I don't see that yet. I just see the same thing I saw in 2018 and 19. I think, though, I believe that if he went early like he did, he's going to have to pull some triggers here because everyone's seen this act before. He can't be caught bluffing all the time. He needs some kind of resolution soon, or he needs to go with the tariffs right away. Okay, so he's got to pick one. I don't think his secretary, I don't know, Lutwick is just not doing good on TV. He's saying if we get a recession, we get a recession. It's not, everyone needs to be on the same page with that. You can't one day say we're going to a recession, we need to go to recession to do this, or then the next day you say we're not going into recession. So the Trump team has to come together and everyone stay on the same page, because it doesn't look good when one person says one thing and the other person says other out there. And Bissett's much better on TV than Lutwick is.
Okay, let's talk about inflation, since you just brought up recession.
Yes,
and let's talk about it.
And inflation, interesting week on the sides, because if you looked at the headlines of the report, they weren't bad, but the internals of the inflation report weren't great. And this is why you saw bond yields kind of react a little bit negatively. Well, last month, the PPI inflation data was hot, but the internals wasn't. So, on the CPI side, shelter is going to still do its disinflation thing. Oil prices are at that kind of lower end of that range. Boy, if you guys look at an oil chart, you can see that there's the mother of Gandalf lines right there that's been holding up. I don't believe the oil producers want to see oil between 43 and 53 bucks a share. They're going to be stopping production at that point. But in this context going out in the future, we haven't seen any of the tariff effects yet on the inflation data. You'll start to see if they sign something and it goes in after a few months, it'll be there. But the inflation we've made great progress on it, but it's still not good enough because the labor market is still intact. And I think this week, even though the inflation data took a lot of the headlines, the job openings data and the jobless claims fell again. So we're still kind of, even though we're off the lows, we haven't broken anything negatively on that. So those things to me matter more than the inflation data. And we can see that the 10-year yield, like the last thing I saw was like 4.26 because stocks were selling off. So we'll see, and keep an eye on that 4.15, 4.18 level on the 10-year yield. If you really want that next leg lower, that 10-year yield has to close below that to get follow through bond buying. We go test the Hodor line after, but until then, labor data actually held up, right? It isn't spectacular, but it held up. And that to me was the big story of the week.
That is a huge story of the week, considering all the things that hang on that. Logan, thank you so much for talking. We will talk again soon. Appreciate you helping us through this craziness.
My pleasure, Sarah. Always here, 24/7.